Welcome back, everybody, for another episode here of CRESI's Ontario Landlord Series. Today, we're joined again by a returning guest, a friend of mine, one of our core educators here with our investors, Mr. Shawn Quigg of currently Cardinal Law, and we'll talk about that later. But today we are going to discuss, you may have heard me say this before, I say a lot of times, start small, build for tomorrow. Well, we're going to add on to that today. But we're going to talk with Shawn about structuring your portfolio properly and growing it strategically along the way. So thanks for joining us this morning, Shawn. How you doing?
Kev, thanks so much for having me back. I love coming on and talking real estate investing and how to do it right. Right, there's a lot of noise out there, but I love coming on with you because you value the right piece, right? The piece about doing it right and getting it right in advance of finding bigger, more expensive problems later on.
Right, being ahead of the game, understanding what you're going to have a possibility of encountering. I do know that I used this analogy the other day, actually, and I'm going to use it again. It's sometimes like a choose your own adventure book. Remember when you were kids, did you ever read that? Where it's like, turn to page 11 if you want to fight the dragon,
Goosebumps?
turn to page 22 if
Yes.
you don't. We kind of do this as well with this, but we have to know what we're expecting with either which way we want to go down our path. As investors, we're as individuals, our fingerprints, and everybody wants something a little bit different. But it's about what makes the most amount of sense for them. And I love that you said it's about getting the correct and proper information out there. Sadly, with the world and the internet today, you can get information on everything and 10 different opinions about the same thing and what color the sky is, for example. And just spoiler, there's now aliens, which is confusing to me as too, but that's a topic for another day. Let's stick with real estate and the investing and structuring small. So let's take a new investor along the journey from the very beginning when they're thinking about starting to buy their first investment, all the way to when this person, when we're talking about today, this avatar is ready to retire from their day-to-day job and actually just live off their investment income. So here I am. My name's Frank, and I just bought my first townhouse pre-construction, and now 4 years later, it's ready for me to turn into my rental.
Well, wouldn't that be nice to be able to retire on your cash flow, which I think is most people's goal. It, but it is tough to get there. It's tough for a few reasons, right? We've got the capital challenges, right? We all run out of money at some point, unless we're born into extreme wealth, which is frankly quite rare. And you're going to run into problems along the way. Real estate is not. I mean, everyone can tell you it's a passive investing business, and to some extent, it is. But there's nothing truly completely passive about real estate investing. And so you're going to run into problems along the way. The people that get to the retirement phase so that they can live off the cash flow and what they built are the people that have solved problems successfully and profitably, which is probably the number one challenge in our industry. But let's talk about Frank, our first time investor who invested in a pre-con 4 years ago, which would have been at the height of the real estate market in 2022. So sorry about that, Frank. um, but let's talk about structuring. So, you've had Mike on, who is a CPA. I can't remember whether you've had any mortgage brokers on, but what I first want to talk about is there is no right answer for Frank or anybody listening to this. Really, what we need to consider are the opinions of at least three professionals, right? I'm a lawyer. I'm helping investors every day, whether it's dispute resolution, acquiring their next apartment building, or figuring out their corporate structure and strategy, which is another piece for later. But when it comes to starting, you need to consider the input of at least three professionals. The first is your lawyer. The second is your accountant, right? It's important to make sure that you find an accountant that is willing and able to grow with you right off the bat. Now, you may find that you'll grow all of these professionals along the way, but it is important to find someone who you can connect with at the beginning. And the third is your mortgage broker. See, the way you finance and scale your portfolio changes, or it can look different depending on how you are structured. And so it's important to get input from these three professionals sort of at the same time. Now, what you really want to look for, Frank, is someone who doesn't wear the blinders, right? Someone who can see the proverbial forest through the trees, in essence, who can appreciate the perspectives of others. Because I'll tell you this, I'm going to have a different opinion than your accountant, and I'm also going to have a different opinion from your mortgage broker, very likely. Our role as professionals is not to tell you what to do. It is to put you in the position to make the best choice based on the information you have and what you are most concerned about in the future.
I love that.
So right off the bat, the biggest question I get is, should I incorporate? And Frank, who's buying his first pre-con, probably shouldn't for probably three reasons. Let's talk about the big one. A corporation is a great idea. And if I was wearing those blinders, I would tell you absolutely yes. Except we are in this game to make money. It costs money to incorporate. It costs money to have a bookkeeper, which is fine. You need one anyways, whether you're incorporated or not. But it costs money to have a bookkeeper. Every year, a corporation has to file 2 returns. Most people know about the one return, the tax return, the corporate tax return, and where you declare your income and expenses and your margins, and then you pay corporate income tax. Okay, great. That will cost you $2,500, $3,000, maybe a bit more, right? Every year. Then you need to file a legal return. And to file your legal return, you must update your minute book. And you have to coordinate, your lawyer has to coordinate with your accountant to make sure that the minute book is actually, the updates are accurate, right? One of those updates is the dividend declaration. We also need to reappoint the directors, reelect the officers every year to keep in compliance with the Business Corporations Act of Ontario, or if you're listening elsewhere in the country, guaranteed your provincial statute also has this requirement. Now, in Ontario, the legal return is a form that is filed with the province, and in it, it says that you've filed your tax returns and have updated your minute book. That's going to run you somewhere between, $600 to $1,100. So if we add all that up, not including the cost to incorporate, you're like $4,000. Now, if you have a single family home, that's like $350 a month gone to your professionals. It makes no sense. The benefit is outweighed by the negative cash flow that will result. And so, right, and I'm assuming, and I probably shouldn't, but I'm assuming that most people understand that corporations are separate entities under the law, which means they can sue and be sued. It brings in the concept of privity of contract, which I will talk about until I am done being a lawyer. Privity of contract is a legal concept that says only parties to a contract can sue on that contract. And why is that important? Well, when you incorporate and you enter into a contract with a tenant, with a lease, or with some other, an insurance company or some other entity, only that corporation can be sued, not you personally, right? This is how we separate our personal liability from our business liability. And so while, yes, it makes complete sense from a strictly legal standpoint to incorporate our very first venture, it often doesn't make sense from a practical standpoint. Now, obviously, I'm happy to incorporate someone who, or Frank, but I would much rather see Frank succeed, right? I want to help build and be a strategic partner as he makes his way to retiring off his cash flow. And so there's no way Frank's going to be able to do that by incorporating right away, because he would just be behind the proverbial 8 ball the whole time.
So just, and I'm going to just jump in right here real quick. One, we are talking about generic situations. We're being very general with this. This is a disclaimer more to protect Shawn than anything else here. This is not legal advice. This is just conversations that we're giving on a general basis here. And also, I get it, and so does Shawn, that he said it already. Most people are not going to get to the point where they're retiring off their real estate income. But some people do want to get that far. Most people just want to build a nice little cushion for retirement or have some extra income now and savings and legacy and leave to their kids, etc. So just because we're having this conversation and we're taking it to the extreme, this is still very valuable for everyone that just wants to get further along their path. So if you're not wanting to retire off income, still keep listening. Don't turn this off, because Shawn's going to keep helping you out with how you want to best protect and grow your portfolio, whether that's to 2 properties or to 12 or to 20. Okay. Sorry, let's get back to it. So now we have our 1 property and we're going to go acquire something else.
Well, as you start to acquire more properties, whether that's one a year or one every couple of years or one a month, which would be pretty wild. But if you're acquiring properties and you start to build a little portfolio, you will find that you're going to start to run into some challenges, especially on the financing piece, which is why it is important to build a good relationship with a good mortgage broker who can help you walk through this. Now, you'll also find, if you've acquired a couple single families or a couple small multis, which I define as 4 units or less, you will find that you get stuck in a murky middle. Here's the reason. When you buy fourplex, triplex, duplex, you get the benefit of residential financing, which sounds great in theory, but is in practice or in terms of scalability quite difficult. And here's why. When you buy with residential financing, it is not the property that qualifies for the financing, it is you. And as you own more properties personally, your ability to debt service your portfolio decreases. Even with cash flow, right? You've got to hit that 1.2 debt coverage ratio every time, and your income is worth less and less. In fact, I think even the rules recently changed about this, which sort of makes it even more difficult and challenging, which is why you want to start playing Monopoly. And by that, I mean trading out your single families and your small multis for hotels. Now, not actually hotels. I'm talking multifamily that is big enough to qualify for commercial financing, for typically more than 5 units or 5 units and up, depending on the bank, right? There's one bank that will consider 5 units for residential and the rest of them consider 6 units.
I was going to say RBC is the only one I know that will do 6 units at residential cost.
Yeah. Once you get into commercial financing, it is actually, before we get there, in residential financing, good corporate structuring is frowned upon. I want you to think about lenders like factories. They have mortgages on an assembly line, right? Mortgage applications like this, and it's never ending. So if anything's not quite to their buy box, they just discard it. And one of those things that gets discarded, and one of those scenarios, is where a corporation owns or is going to own or borrow against real estate, and that corporation is owned by another corporation. That is how you properly structure real estate investing for a number of reasons. In fact, Mike on his episode talked about corporate structuring from that standpoint, so I don't need to touch on that too much. But what you'll notice as a real estate investor buying small multi is that good corporate structuring is actually going to get in the way of buying small multi. On the flip side, buying multifamily that is financed commercially, commercial financing, those underwriters are looking for proper corporate structure. They're looking for a corporation owned by a corporation amongst a portfolio. They are looking for limited partnerships in the event that you've reached the scale where that makes sense. They are looking for mutual fund trusts. If you have reached that scale, which is way up there, and for the super advanced investor, and even then only at the most advanced, because that is quite a tool that has quite a bit of regulation around it, they are looking for properly drafted shareholders agreements, right? So as you start to play Monopoly and trade out your small multi for large multi, 10 units, 15 units, 20, 50 units, you will start to find out that you need to raise some capital. You need to structure that capital raise properly, whether it's through a limited partnership or through a private issuance of shares in a corporation. Right? You will need to make sure that as you start to gain momentum and build a portfolio of multiple multifamily buildings or commercial buildings or whatever it might be, industrial, warehousing is big, data centers are big. As you start to build that portfolio, you'll want to make sure that your corporate structure builds with it, right? That means having just the right number of corporations to handle your portfolio, not too many, because again, you got to file a corporate income tax and a corporate legal return for each one of those corps every year. Though you will find that as you have more multifamilies, more units, you achieve economies of scale such that it actually makes sense financially, economically, to pay your accountant and pay your lawyer to make sure that those things are run properly. And so, what's really important to keep in mind is you'll probably want to get out of the small multi at some point relatively quickly, as soon as it makes fiscal sense to you, because the small multi space is that, you kind of get stuck in the mud on the financing and scale piece.
You can only get so big there. And I like the analogy that you used about the mortgages in a factory, and that's bang on. Most of them, the underwriters are looking for specific things. And if they don't see them, they just say, this is not an easy deal, right? My lender's not going to want this. And we can't get it done. Where if you have a investment-minded mortgage broker that understands this game, they will know how to tell your story, how to pitch the product, how to package it up so that a lender will want to get on board with this. And that's what it's all about on the financing side. It's again why we keep circling back to having professionals on your side that understand what you're doing, your goals, and how to help you succeed. Anyways, yeah, I like that one about the factories because it's bang on. I'm going to use that one again.
So let's touch on the last piece, which is, you've got a portfolio that's right for you, right? There's one other piece that a lot of people are really remiss to talk about or consider, and that's what happens when we eventually graduate from this planet. And the reality is, one out of every one person dies. We just don't know when. We also don't like contemplating our own demise, but smart business people do. Smart business people plan. And so there is one tool that, there's a lot of estate planning tools, right? We can talk about share freezes. We could talk about estate freezes. There's a lot in the Income Tax Act that is built to help people transfer wealth to the next generation. But in my view, the single best, most useful tool for real estate investors when it comes to estate planning is what's called a secondary or corporate will. So you need a will. Everybody knows they need a will. Everybody likely knows they need two powers of attorney. One for person, right, to make decisions about your body when you are not physically capable of making decisions for yourself, and one for property for those who are not able to make decisions, but decisions need to be made about real estate or cars or other assets. Right? Everyone knows that they need those items, but not everyone knows that they need a secondary will. And here's why this tool is so good. In Ontario, when you pass away, if you own just one asset that is to go through the probate process, and if you think about assets, there's sort of two buckets. One bucket is these go through the probate process, and the other bucket is these don't necessarily go through the probate process. But if you own just one asset that goes through the probate process, which would be your primary residence, if you own just one of those, then all of your assets go through the probate process. And if they do, then you owe the estate administration tax on the fair market value of all of those assets at the time of your death. That can include shares in a corporation. And the shares in that corporation are valued at the value of the real estate. Not the value of the real estate less the mortgage, not the equity, the fair market value. Right? So if you own 10 million in real estate and 8 million of it is leverage, you're paying tax on 10 million, not 2. So what the secondary will does is it takes all of those assets that shouldn't go through the probate process and accepts them out of the probate process. This is why, for real estate investors, the secondary or corporate will is the most important tool to get under wraps and done. It's a relatively inexpensive investment for a huge return, especially considering we just don't know when our time is up. It could be 40 years from now. It could be tomorrow.
I was going to use your time is up, and we're going to pretend like this is a TV show where back in the day where there's a commercial break. We're going to bring you back and we're going to dive into that secondary will and really explain that to investors, because that is something that I think we have to get into for everybody. It's a piece of information that I bet you most don't understand and need to. So yeah, that's our next conversation for sure between you and I. I love it. Um, do we want to leave off with anything there today? Like, I don't want to cut this short either, but I just think if we keep going down that, that's an actual episode on its own, right? So when we're
For
looking
sure.
at structuring here, and getting that all up, we're going to leave that secondary will, because that is going to be something that we're going to dive into. But really, what we're talking about here, and I think it makes a lot of sense. You're going to go as you grow from you're having your single families, your small multis, right? And then if you want to get into it, those larger apartment buildings, like Shawn said, they're now being funded off the asset, not your personal income and finances. So it's a great little way. There's also stuff we're going to get into about small retail plazas and stuff like that as well, which are also commercial and great for investors to get into once they get out of that initial stage. Um, yeah, Shawn, wait. No, we're not going to leave it just yet, because there are some things I want to share as well. So you're probably seeing this episode and the one before where Shawn was branding was with Cardinal Law. They are rebranding. I'm going to let them talk a little bit about that as well. And also, I'm just going to plug a little bit about what we have going on with our CRESI Investor Network. Shawn is one of our core educators on the legal side, and he's always going to be around to make sure our investors, our landlords, our realtors, our members are going to make sure they have all the correct and proper tools to succeed in this game. So, Shawn, why don't you tell us a little bit about your branding, why you're doing it, and I'll let you have that little plug here.
Yeah, well, thanks, Kevin. So I'm so proud and pleased to announce that Cardinal Law has rebranded to be Rook and Knight Commercial and Investor Law. And what we wanted to do was take what we built and transform it into something that communicates to the world what we do. Um, and what we do is commercial real estate, investor real estate, and the entrepreneur type law, the corporate structuring for businesses, the acquiring of businesses, et cetera. We're here to help people make money and look good doing it. And for me, Rook and Knight really is a transition to sort of measured strategy. It is, chess is a calm game unless you're at the Worlds where they're smashing the timer and getting very excited. But chess is generally a calm, measured game, and that is exactly how we approach our work. Right? Buying real estate can be very stressful, especially as you get into bigger numbers and bigger consequences. And so we wanted to sort of bring this measured and stoic approach to commercial real estate. Now, if you might think commercial real estate refers to plazas and malls and stuff, but it actually does refer to multifamily and really anytime you're buying real estate for the purposes of making money. And so we're soft launching right now. We haven't launched our website yet, but we're spreading the word that we are narrowing down into commercial and investor real estate law and commercial law. And so I'm very excited to announce that today.
Amazing. Love it. Congratulations. I like it. I like the strategy, and like everybody says, right? Niching down to level up. And this is why we have our group of core educators that specialize in the investment world, right? We do this every single day, helping investors, helping landlords. Um, and it's not just like we helped our cousin once buy a duplex in Kitchener. We do this all the time. This is who we are and why we want to make sure that your investment journey, whatever that may be, is the best and smoothest possible one it can be for you and whatever your goals are. So yeah. Lastly, I'm just going to share what's coming up in our world. We're going to have a one big day event where we are going to be educating realtors, investors, landlords, aspiring landlords, whatever, people that want to understand how they can get started and build this properly, with education and information at the forefront, not just how to acquire properties. Another thing that I say all the time is buying your rental property isn't the big win. It's just when the game actually starts. becoming a landlord is when the game begins and a housing provider. So with CRESI Property Management and everything we do on that side, it's about helping you support afterwards. And now this group is going to come together, not just on the management side, but legal side, financial side, whatever you're going to need in support. And advocacy is another big part of this, to make sure that landlords are all coming together as a community and helping support one another, maybe make some changes here in the province of Ontario. Because if you've been up to date, we haven't had much come in our favor in about 2 decades, except for Bill 60, which just happened recently, and they're still now back and forth against us again, with more things being passed, with leaving us responsible for illegal activities, etc., that we have to try to battle back against. Anyways, another topic for another day too. I don't want to get off into a tangent there, but this is a great conversation. I hope everybody out there got something from this. Shawn, let's say goodbye, leave them with some final words, and we'll be back to talk about the secondary will on another episode.
Well, Kevin, thank you so much for having me. It's always great to sit down and chat with you about real estate investing and how to make it work in everyday life. So if you're a real estate investor and you're listening to this, be and stay curious, right? There is so much to learn here. There is so much to digest. Trust the people that you feel the best connected to help you guide or help guide you along the way, and then take action.
Love it. Get a professional to guide, advise, consult so that you can make the best decision for you. As always, thanks so much for listening. Tell another landlord, tell a friend. This is where they got to get their info from. We're here to help, and we'll catch you on the next episode. Bye for now.
Please remember, while we are professionals, this podcast is for informational and entertainment purposes only. The advice shared may not apply to your unique situation. Always seek personalized advice from a qualified professional before making any investment decisions.
Hey everybody, thanks so much for joining us this week. I hope you enjoyed the episode. If you're finding it informative and useful, make sure to like, subscribe, share with a friend so that we can keep getting the information out there to Ontario landlords. And keep on joining us. We'll see you next time.